This is Alan Bush with the Daily Financial Forecast for Tuesday, August 30th. Starting out with the stock index futures, we did see a little pressure this morning. This after Fed Vice Chairman Fisher making comments on Bloomberg television indicating that the Fed funds rate could be increased sooner than some analysts had predicted. He said that the employment number is basically reaching a full employment situation. So those hawkish comments on balance, putting some pressure on the indices. Also, we did see some recovery, though, with consumer confidence coming in quite a bit better than expected. Also, we do feel that longer-term stock index futures will continue the bull market. In fact, even though we are lower today, I think we can see a move back to higher on the day. And any gains, I think, are likely to be very long-lasting through this year and probably well into next year. Now, moving over to the currencies, the dollar index advancing to a 3-week high, being supported by Fisher's comments. Don't forget, we do have the next Fed meeting scheduled for September 20th and the 21st. Even though there's only a 36% chance that the Fed will raise at that meeting, the probability of a rate increase at that meeting has increased recently, and that has supported the dollar index. Also, do not forget that the Fed is the only major central bank that appears to be on course for some type of tightening. Every other major central bank is either in an easing mode or is likely to add more economic stimulus down the road. So that should underpin the dollar longer term. Some pressure in the euro currency after inflation numbers in Germany coming in a bit on the weak side. A little pressure in the British pound after UK mortgage approvals coming in at an 18-month low, and some additional selling coming into the yen after recent declines. This on the belief that the Bank of Japan at their next policy meeting on the 21st of September will be adding more stimulus. And of course, more stimulus means lower rates. Lower interest rates, lower rates usually equates into a lower currency. Now moving over to the interest rate futures markets, lower prices there as well, with Fisher's comments, a bit of a negative influence. Also some additional pressure with the consumer confidence number coming in as strong as it did. We do feel that longer term inflation globally will be more and more of an issue. And don't forget that inflation tends to affect the long end of the curve more than the short end. So we would focus any negative thoughts and any bearish positions on the 30-year bonds. So longer term, look for lower prices in the 30-year Treasury bond futures. And over the near term, within the next couple of weeks, I think that we can take out the 170 support area that has held a couple of times in the September 30-year bonds. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.